off, and then more might join later on. Well, welcome everyone to our seminar today. My name is Jonathan Farrer. I'm a partner in the corporate advisory team at CORRS Chambers WestGarth, and I also lead the startup practice at CORRS as well. So today we're talking about a really interesting topic that we come across a lot in our role, and I'm sure it's of interest to a lot of startup companies as well. It's around traditional capital fundraisings versus alternative sources of capital. So we've got a panel session. I'll run through the panelists in a minute. I should also note just that we do have questions and answers, a Q&A function as well at the bottom of the Zoom screen. So if you do have any questions throughout the seminar, feel free to put them in the Q&A box, not the chat box, the Q&A box, and we'll try to answer those where we can throughout the session. So as I mentioned today, we're talking about traditional capital versus alternative capital. When we talk about traditional capital, we'll run through the different categories, but we'll cover things like bootstrapping, family and friends raisings, family offices, angels and VCs as part of the traditional capital. And then for the alternative capital, we'll look at a few things like licensing deals. We'll look at grants, government grants, crowdfunding, and a few other options. So maybe before we jump into that, I'll introduce you to the other panel members and just talk a little bit about CORRS. CORRS, as I mentioned, is a large business and corporate law firm. Most of our clients are large companies, but we are very passionate about working in the startup space. And about 5 years ago, we established an online platform called CORRS Edge. And we work with a lot of startup companies in helping them raise funding, get their IP sorted out, various other issues. And we give them access to our CORRS Edge platform, which means essentially they're getting access to really top quality startup lawyers, but they're also doing that in a very efficient and a cheaper way than maybe you'd otherwise engage with a big law firm. So if any of you are interested, we're happy to chat with you afterwards in a bit more detail about CORRS Edge and what that offering involves. I might just ask our panelists to introduce themselves. We've got Kon Mellos, Anton, Bobenko, and Fran, Wheelahan, and I'll be sort of moderating and asking each of them some questions as we go. Maybe I can just kick off with you, Kon, just to do a quick introduction from your end.
Well, thanks, Jonathan. Hi, everybody. Yeah, my name's Kon Mellos. I'm a partner. I work closely with Jonathan Farrer in the corporate advisory financial sponsors group practice at CORRS. And have been working in the venture capital space now for 30 or odd years. Started off working in that space for a financial institution in London in-house as a lawyer, and have been doing that ever since I returned back to Australia. And I tend to focus more on advising venture capital firms than startups themselves, and I bring a sort of venture capitalist perspective to our discussion today. And help venture capital firms with their raisings of their funds, and also in investing those funds into startups and later rounds, and also helping them with exits.
Thanks, Kon. Hi, everyone. Great to see so many people on the session today. My name's Fran Wheelahan. I'm a partner in the IP and technology team at CORRS and routinely work with Jonathan and Kon and Anton in connection with capital raising and commercialisation of IP. So I'll be talking to you about licensing of IP and grant arrangements, etc. Anton?
Thanks, Fran. Hi, everybody. My name's Anton Bobenko. I'm the relative baby or startup of the presentation panel. I'm a senior associate in our corporate group. I work with Jonathan and Kon on a wide variety of fundraising and investment transactions, acting for startups and investors. And I, like Jonathan and Kon, have been working with LaunchSpeak on a couple of programs over the last 12 months. And it's a pleasure to be able to join with Fran, Kon and Jonathan to speak to you today about our old and new funding strategies.
Thanks everyone. So Anton, I might start with you. We're talking about traditional capital to start with before we move on to alternative sources of capital. And if you look at the startup journey, most startups usually begin with a sort of bootstrapping strategy where they really try to, I suppose, go as far as they can without actually raising external money. And it's really the founders who are funding the business for a period of time while it gets off the ground. Can you maybe just talk about that? And I suppose, you know, often that does involve a founder, you know, quitting their job, taking out a mortgage with the bank, putting their own personal assets on the line. Some of the, I suppose, the issues to consider at that phase of a startup's journey.
Oh, thanks, Jonathan. I'd be happy to. So yes, bootstrapping. It's probably accurate to say that the majority of startups, you know, begin that way with bootstrapping to some extent, and we did a bit of digging into the statistics before the presentation. That definitely shows up both here in Australia and in the US. So what that, you know, as you would know, bootstrapping means, and Jonathan alluded to this, it's talking about the founders using their personal finances, and then beyond that, the business using its operating revenues to run and grow the business. So when you're thinking about the founders providing personal finance to the startup, that's probably provided either by way of equity or debt. And the lawyer in me can't help but to remind the founders among you that it's important that any funding of your startup be documented, and if you're going to fund it by way of equity, that the company and the asset records are kept up to date. That will become important when you come to sort of later funding rounds, or you're looking for external finance otherwise. So you know, the story of bootstrapping isn't all negative. It's not. I don't think I would characterise it as a failure to attract external, necessarily the failure to extract external financing. I see bootstrapping as an opportunity for the business and the founders to develop a track record of their own backs, which will, if you succeed at that, you'll be in a strong position in later funding rounds. And this will become, you know, you'll appreciate this more as if you do get external funding in. While you're bootstrapping, while you don't have external input, you'll have greater flexibility over the running and direction of your business. Lastly, it encourages businesses and founders to be efficient and problem solve. There are downsides to bootstrapping. There are considerations to bootstrapping. Not having that external financing can delay or stunt the growth of your business. You also possibly have reduced access to the very valuable input of experienced venture capitalists and other investors into your business and growing it. And you may not develop the discipline, in particular financial discipline, that comes with meeting the expectations of third-party investors if you're bootstrapping. It's worthwhile touching just quickly on bank finance. Jonathan mentioned it. That could either be provided to you, I'm talking to you founders, it can be provided directly to you, or as your business develops down the track to your startup. That finance will be in the way of cash loans. It could be lines of credit, could be credit cards from established bank. If you're thinking about bank finance for your business, when you're at that stage, just keep in mind that if you don't have a strong revenue stream to support a loan, the banks will probably require the founders to provide personal guarantees and collateral. But it's also sort of the case if you're looking to, as founders, to raise that money directly. And in many cases, for individuals, founders, the only suitable collateral for a bank is the family home or other properties of the founders. And this is an increased focus following on from the Banking Royal Commission and during this COVID-19 period, that the banks are looking for solid collateral. Even if you before a stage where your business is looking for bank finance, I think it's a good tip to find a bank and find a bank manager at the outset and develop a relationship with them. The length of your relationship with the bank manager and bank will, when it comes time to getting some bank finance, develop in the bank and the bank manager greater confidence in your business, and you'll have an easier time through the bank loan application process if you've had that longer, deeper relationship. So, stating the obvious, if you are thinking about bootstrapping with the assistance of bank finance, whether you personally, founders, or through your business, you've got to think about your or your business's capacity to meet repayments. You've got to think of the risk of losing any collateral, which is possibly your house. That's a significant risk, and the costs cost of that finance because of the interest and charges on any money borrowed. And you've got to balance all of that up against the upside, which is the potential for growth.
And Anton, we'll talk about other sort of external investors a bit later, but often family and friends are that sort of interim funding source where you've perhaps run out of money yourself, but you need more money to grow the business. And often family and friends, it's a bit easier raising from them at early stages than external investors who might be slightly more rigorous in their sort of due diligence and investment criteria. Do you want to maybe just talk a bit about family and friends and some of the things to think about when they're coming on board?
No, I'd be happy to. Thank you, Jonathan. Yeah, no, it's true. And it's an extremely common first source of capital for early stage startups. I've seen some statistics that suggest that over a third of startups raise capital from friends and family. And in fact, a greater aggregate amount is invested in startups by friends and family than any other source of capital. So, it is a go-to and it's a good source. In our experience, we typically see friends and family, when they do investing anywhere between 10 and say 150,000. However, in this COVID-19 environment, friends and family may be more cautious, or they may be more cash strapped. So it perhaps wouldn't surprise me or us to see friends and family as the less reliable source of funding that it has been to now until the economy sees an uptick. But if I step back from the current events, and as you suggested, the advantage of friends and family as an investor class is that they typically don't require extensive legal rights and protections. They're backing the founders and their relationship with them as much as they are the business and the legal rights they may get as part of their investment. With that, the key trade-off is that you're mixing business with pleasure, and a souring of that business relationship may affect the non-business relationship as well. So it's really important, if you're looking to friends and family for support and investment, that notwithstanding that you're acting off the back of that affection and that contact relationship, that you document in a formal way any investment and you maintain good and regular communication with them. It's also critical that you carefully explain the risks of the investment, and most importantly, the risk that they could lose everything, which is the case particularly if they're making an equity investment. So we typically see friends and family when they do come in, they're either making cash gifts to the founders of the business, or they're lending money or taking equity in the business. Gifts are the least complicated form. If you can get gifts of money to start your business, that's great. If you are going to be borrowing money to fund your business from friends and family, be sure that there's very clear understanding, a documented understanding of the interest and repayment terms. And then if you're looking at receiving equity, what's critical when you're issuing equity, especially in startups where there isn't a track record, there aren't significant assets in the business. What's critical is how the business is to be valued at that time. So that's relevant to somebody coming in at that early stage, because you've got to work out how much of the company they get for the money they invest. And it may be preferable with these early investors to look at them investing through an instrument where valuation is deferred until third-party money comes in. And so that could be by way of what was known as a SAFE instrument, a simple agreement for future equity, or a convertible note. One important last consideration about family and friends coming in as equity investors, and it applies to any future funding round, is that you as founders don't want to over-dilute your interests. You want to maintain control, and you've got to ensure that if you follow the traditional trajectory of a startup, that you can expect multiple funding rounds, and you've got to have enough fat, enough equity to issue while maintaining control for those future funding rounds. So if you're tossing up with friends and family whether it's going to be a loan or whether it's going to be equity, carefully consider whether it's necessary to issue equity, and then if you think it is, then carefully think about how much equity should be issued.
Yeah. And there's also, it's worth, if you are doing a family and friends raising, it's worth thinking about whether you qualify for an ESIC as an ESIC company, early stage investment company, because for investors, external investors investing, up to $200,000, there are some quite attractive tax benefits for you. Maybe just moving through to external investors. I suppose when we think of external money coming into the company, equity money coming into the company, we think of high net worth individuals, we think of family offices, angels, VCs. I might throw to Kon to talk about angels and VCs, but Anton, do you just maybe quickly want to talk about family offices and high net worths and how they fit in? Yeah,
sure. So family offices, don't know who they are. They're platforms set up by high net worth individuals or families who invest their wealth. In a number of respects, they're at the other end of the spectrum to friends and family. With family offices, what's critical is developing rapport relationship between the founders and the family office and with the business plan. Whereas with friends and family, that confidence, that relationship is a given or expected. Friends and family may be flexible on terms, maybe that might not be the basis of their investment. Family offices will pay a lot of attention to the terms and possibly require a degree of influence and control. They're not easy. It's not easy to get in contact with family offices or attract family offices. In our experience, they rarely respond to cold calls, and the preferable way to make a connection with them is via an introduction through a mutual connection, if you can. So what we see is people accessing family offices through business or financial advisors who already have those connections. Probably fair to say, I think, that family offices tend to be more conservative investors and possibly more conservative than angel investors or venture capital investors, and they may be less willing to invest in early stage startups given the risks and the absence of track record and third party validation. But having said that, I think there'll be some family offices out there who right now are in a very good position to take advantage of opportunities through this COVID-19 period, and they may not be looking to pull back from their investment activities as some other sources of capital might be. So I think it's worth keeping them in mind if you're looking for capital at this time. But just with a few final tips on interacting with family offices, remember that it's often the case that the original wealth source for the family office is the ultimate decision maker on any investment. They might have there might be a number of people in the organisation, but ultimately the decision is made by that original wealth source. So keep that in mind. They may also value a more streamlined, efficient style of communication than other investor classes, and that could be because they may perhaps have less bandwidth to consume large amounts of information. So keep that in mind. If you're thinking about approaching family offices, because you need to build that rapport with the family office, really sell them on the business plan, leave a good amount of lead time to build that rapport in your timetable. And lastly, and this is possibly most important to family offices, they greatly value privacy and confidentiality. So be very sensitive to that as you're discussing a potential investment with them, and then after they invest, if they do.
Great, thanks, Anton. I might throw to Kon now to talk about angel investors and VCs, which is often when we think of traditional capital sources, that's often what we sort of first think of. So maybe to kick that off, Kon, when is a startup company ready to start talking to angel investors and VCs? Where along the path do you need to be?
Yeah, thanks, Jonathan, and thanks, Anton. Yeah, this is really sort of territory that's sort of more suited for startups that have been sort of generally established and that sort of got past the sort of very early stage of their sort of startup evolution. Angel investors can tend to come in sooner than venture capital firms or at the same time. And sometimes as angel investors can be in the form of, high net worth individuals or some family offices, operate in that space. So it sort of overlaps a little bit with what Anton said as far as angel investors, or they can come in at a stage as venture capitalists. But what they typically look for at this stage is, as I say, a startup that's generally well established. You would anticipate that to be attractive at that stage, the startup would need to have what's called a minimum viable product, MVP. So what they would look for is that as far as its technology is concerned, that it has developed a basic version of the product, and that basic version delivers its main core value to the customer, and that there's been sort of validation and feedback from consumers before they want to take it to the next stage and launch to a mass market. So it doesn't have to have all the bells and whistles. It doesn't have to be fully developed technology, but its core competencies need to be there. I sort of think back, and I think so like a good example would have been Snapchat. You look at Snapchat today, and it's a very, very different product to what it was when it first started attracting venture capital. What really sold it to venture capital firms was its sort of auto-delete function, so that any messaging or information or data would automatically get deleted. That's really what would have been called the minimum viable product that Snapchat had. And yet people forget about that these days. There's all the other add-on functions that have made that company such a great success. So you would typically need a degree of proven customer track record and a degree of revenue, and a product that the venture capital firms would be considered that is scalable and it's ready to take to the next level. I mean, they're the key criteria the venture capital firms would look for.
And Kon, in terms of VC and angels as a pool of capital, I mean, they obviously bring a checkbook, but they also bring some other advantages in terms of their networks and just their experience with other startup companies. Can you maybe talk about that a little bit?
Yeah, absolutely. Yeah. So, and just to finish on my earlier point, one way of summarising that as well would be, this way of saying is, a venture capital firm can help a startup to begin running, but it will already need to have started walking. So that's the stage they come in. But they, as your question alluded to, Jonathan, is one of the selling points and something the venture capitalists, venture capital firms would espouse and say they bring to startups, and certainly we've seen that come to fruition, and we see that a lot, is the mentoring, the networking, the value-added services they bring. So it's more than just about money and what they're getting in return for money, the terms, the percentage of the equity, the rights they would have as an investor. So when a startup is at a stage where it's talking to venture capital firms, it's really, really important for the startup and the founders to do their diligence as well. In the same way that the venture capital firm is doing its diligence on the startup and the founders need to do their diligence on the venture capital firm to work out where they're the best fit. Different venture capital firms can take very different approaches. Some are, sort of more team-oriented, some are more aggressive. But also, it's really important to look at what those value-added services are. What else do they bring more so than a checkbook? And some venture capital firms, we focused in particular sectors or industries, and they may have had past experience in growing companies that are in the same space as your startup. It's really important to work that out and understand what their experience is and what else they bring more than money. So, that would be, based on their past experience, the contacts they've developed throughout the market through, their many years of investing, their experience with what works and what doesn't. We all know that marketing and distribution is critically important. That's what scalability means, and that can come at a massive burn rate. So, you need to look at, what experience a venture capital or an angel investor can bring, to help manage as efficiently as possible that critical process, and how, they can help this business even migrate into other markets. So a lot of venture capital firms have that experience, and they say they have that experience, but some do it differently to others. So it's really important that that be a two-way dialogue to work out that they are the best fit, because they will be a partner for the long term, and the future of the startup will very much be dependent on the venture capital firm as well. Another core strength of theirs is delivering an exit path for the startup. Having done it all before, whether through an IPO process, through a sale, or even through, and also helping the venture capital firm in finding, its next investors, in multiple further rounds, in Series B, Series D, E, F rounds. And a lot of the firms, have pretty good credentials in helping the company get to its next level, and their contacts within the venture capital community, not only here in Australia, but also internationally, and certainly in the West Coast of the US, bringing in bigger scale investors. And that's also critically important, because we are seeing these days that, startups tend to take longer to get to market. That's not because they're less successful. It's because typically now venture capital firms would want the startups to grow even larger and become even larger and more successful before they IPO them and sell them, because they feel that there's still a lot of growth to go before they get to the stage of, selling them or cashing out. So it's really important to know that, the venture capital firms, and a lot have this experience in going through that whole evolution process and helping the startup along the way, not just with money, but through the other value adds. In return for that, with venture capital, it's accepted that, the startup and the founders will have to give up a degree of equity and a degree of control, not only through the equity they give, through board seats that they give, and through the, approval rights that the venture capital firm and its nominee directors on the board of the startup will have. Venture capital firms will want to be able to sell the company on the same terms. They'll be able to force an exit. So, in return for the money and all these value adds that venture capital firms provide, you do have to give up a degree of control, and you do have to give up a degree of equity. And the important thing is to be satisfied that doing so, is outweighed by the benefits that venture capital firms can bring in a non-financial sense as well, through just growing the company.
Thanks, Kon. Just in that context, we've got a couple of interesting questions. One of which probably ties into the discussion we've just had around investors bringing more than a checkbook. It's around brand ambassadors who are early stage investors, and whether attracting a famous individual as an investor is a worthwhile strategy or a superficial one. I might quickly respond to that and then see if anyone else has comments. But I think that in part it depends on what your startup does, and whether you're really targeting a customer audience that someone who is a brand ambassador will help with the marketing strategy. So I think we've seen a lot of examples of cricketers and footballers and other sports people raise the profile of consumer goods products, for example. and that can be worthwhile. On the other hand, it depends on what you agree with that brand ambassador, how active they are, what they do, because the last thing you want to do is give away a whole bunch of equity to someone on the basis that they're a brand ambassador, but actually they don't really help much on that marketing front. So I'd say probably two things to sum that up. One is work out what your marketing strategy is and where that brand ambassador fits in. And secondly, when you're doing your, getting that brand ambassador on board as an investor, just make sure you're clear about what their expectations are in terms of their role and what they're actually going to be doing for the company. We've got another question on ESIC. I might just come back to that, Con, after rounding off with you, just on traditional sources of capital. COVID-19, what's the impact of COVID-19 been on angel money and VC money?
Yeah. So, I mean, many angels and VCs, that we've spoken to and have gone out publicly saying it's business as usual for them as far as they're concerned. Certainly the same investment fundamentals apply. They're looking for successful, stable, and innovative companies. That can expect to receive, and those kind of companies, and startups can expect to receive funding even during, this current pandemic. There are, however, some others that, might be putting a bit more focus on their existing investee companies and portfolio companies and viewing, looking for new companies as being secondary somewhat at this stage. It's still early days yet, but, some preliminary data coming through shows that there has been sort of a drop in the number of investors, around this period compared to last year. Sort of, it might be, close to about half of what there was last year. But even with that drop, half is, still up on what the rate of investment was a few years ago. We are really looking at, 2019 or thereabouts as being almost a high watermark of investment in venture capital. So, it's coming off a very high base. And if you look at 2019, what the data there shows is a really strong upward trajectory in venture capital investment. Certainly what's noticeable is the size of each investment is growing, so the number of investments might not be growing as rapidly or maybe stabilizing, but certainly the amount that they're looking to put into investments has grown. A lot of it has been sort of fintech, and we've got examples, Athena Loans, Afterpay, Judo Bank, Wallets, they're all in the world's top 100 fintech companies. Agtech is a huge area where we're seeing exponential growth. And record funds have been raised in 2019. So that means that the venture capital firms have almost unprecedented amounts of money to invest, and that they will look to find a home for that money. In March and April, we saw deals being done. Admittedly, many of those were already underway and being negotiated pre, escalation of the pandemic. But there's been sort of, some significant raisings during this period. Fintech still remains dominant. But the other thing to take into account is, if we look at it, we look at the NASDAQ, and as at today, it's 5% up on what it was on 1 January this year. It's at a record high, and it's just sort of indicative that, the one area that has been least affected, as we all know, through the pandemic, is the digital economy. And in many cases, it's thriving. So yes, some investment, there has been some reduction in investment activity, but the outlook, medium to long term, I think is really quite positive.
Thanks, Con. We did have another question around ESICs and whether company startups should get a private ruling from the ATO around ESIC status. We actually acted a few years ago for the first startup company to get a private ruling for ESIC status from the ATO. And I think largely it comes down to what your investors require. Obviously, if you're an investor and there's a private ruling, that provides a lot of comfort for you. But we've certainly worked with companies who haven't gone down the private ruling route as well. So really, it's probably, again, whether your investors require that or not is probably the key thing. The other thing, just to flag with ESICs, is that effectively you need to be an ESIC company when the shares are issued. So if you are getting a private ruling, or you are concerned that you want to raise money, but it may take some time, the other thing you can think about is doing a convertible note issue, which effectively converts to shares, post the ESIC. So you've got the money in the door already, but the holders will qualify for ESIC because they're issued shares post that ruling. I am conscious of time, Fran, so I might move on to some, I suppose, alternative sources of capital. Although we do see, quite a lot of these. So whether something's traditional or alternative is probably a matter for debate. But Fran's in our IP team, as she mentioned at the start, and we work on a lot of licensing deals with startup companies. And I suppose there's a few different types of licensing deals. Obviously, if you're coming out of a university, in particular, you'll need to get that IP licensed, but it can be a potential funding source in terms of licensing IP and a source of revenue as well. So Fran, do you want to maybe just talk about that a little bit?
Yeah, absolutely. Thanks, Jonathan. And that scenario you mentioned where you're getting IP from a university is what we might call a licensing in deal, whereas the startup, you're bringing in some IP that might be crucial to the business and you're licensing that in, and you might need to give something over to get that. And it could be equity or could be some sort of payment. But I guess in terms of alternative capital, we're really talking about licensing out deals where you've got IP that you're licensing out to a customer or someone else. And the first thing to really keep in mind is that your company's IP rights are actually recognised by law as proprietary rights. They can be valued and recognised on the balance sheet of the company, and as personal property, they can therefore be assigned or sold to someone else, and they can be licensed in return for payment. So an IP licensing deal is essentially a deal whereby you agree to make your company's IP available to another party for a specified purpose on certain terms, in return for the other party making payments to you or perhaps providing something else of value. So if you're a startup that has valuable IP, then this is an asset of the company that can be leveraged and licensed to a customer. And you can raise capital that way for further growth of the company. And of course, a lot of the country's hugely successful companies have limited physical assets and instead are built on their IP and their licensing and commercialization of that IP. So Atlassian, for example, with a recent market value of 46 billion US, at its heart is copyright works, the software in the platforms that they develop and sell. And increasingly in their brand, they're really building their brand, which is a trademark and another form of IP. So one of the really important features of a licensing out deal is that it doesn't generally involve the startup needing to give over equity or the licensee being entitled to appoint a director to the board. So that's a really important feature. So licensing may be a way for your company to raise capital, but I think the really important point is to make that the timing needs to be right and the deal needs to be thought through and properly executed. So you won't really be, I don't think, in a position to be entering into a licensing out deal and making money out of that deal until your IP is sufficiently developed. So the customers you're licensing to will generally expect a certain standard of product, at least an MVP. And there obviously needs to be a market for that IP. On the other hand, though, there might be something that you've developed on your pathway to your intended sort of ultimate product or products that another company can see as valuable for another reason. You might have found a tool or solved a problem that they've been trying to solve along the way. So it's a good idea to keep your eyes and ears open for these sorts of potential deals, to know your market, your competitors and your customers, and understand the opportunities. There's no particular sector that's more suited to licensing deals than others. The question, I think, really is the maturity of your IP and whether the timing's right to be entering into a licensing deal. If your IP is not sufficiently mature, then there might be other options to still raise capital utilising your IP. We'll talk about government grants in a second, but the other thing worth considering is collaboration arrangements. So this will be more a collaborative arrangement. It's not just you making your IP available to another party. The other party might have some skills or other IP that you're looking to utilise. And the collaborating party could indeed be a significant commercial party who can see the potential in your IP, might be prepared to kick in some money to fund the development in return for certain rights. And that could be, for example, a right of first refusal to license the technology when it's ready. And large companies are really increasingly, we're seeing, recognising that they need to look outside the organisation for some cutting edge technology. I'm just seeing the banks, I think the CBA in recent days talking about that. So they can see startups and early stage companies as being on the leading edge and able to perhaps move more rapidly and operate in a bit more of an agile pace than the big corporate themselves. So just one or two final points to round this licensing point off, and that is a couple of cautions, I guess. If you're looking at doing a licensing deal, don't do a deal that doesn't give due thought to the future opportunities for your business. If, for example, you go and exclusively license your core technology to another company on a worldwide all fields basis, you'll only end up with one customer and you won't even be able to use the technology yourself. So think that through. And then a corollary of that is that if you're entering into a licensing deal and then go raise capital through some of these other sorts of means that we're talking about, as part of the diligence process that the funder will undertake, they will want to see these license deals. And so if you've entered into a short-sighted deal, that could scupper your ability to secure subsequent funding.
Thanks, Fran. You did mention government grants, which I think often people see as, it's free money. You don't have to give away any equity, and therefore only upside. But there are pros and cons with government grants. Do you maybe just want to talk through that in a bit more detail?
Yeah, absolutely, Jonathan. So there are quite a wide range of grants that are available, and I guess I'd encourage people to at least look into that. There are even people out there who can help you to find the right grant, because sometimes it can be hard to sort of sift through everything. So in terms of public sector grants, there are many types of general grants as well as some very industry focused grants. The public grants, I guess, tend to focus on technologies in areas of public need or where the government might be keen to support the building of jobs or infrastructure or a particular industry. So there's quite a deal of funding available, for example, in the renewables and clean energy space, in public health, food security, defence tech. There's also considerable investment in the space sector at the moment, we're seeing, as Australia seeks to build a national space capability. There's also, I guess, the concept of private grants that could be offered by large companies who are keen to get a look at emerging technologies again. And it might come with that obligation to give them a first look at the technology as it's being developed and an option. And you might also view as a grant, a sort of a private form of grant, as those that are awarded by the accelerator program. So if they're giving you cash for participation in the program, provided that they don't require the issue of equity. So there are a few different sorts of grants that you might seek to apply for. And I guess a grant secured by an early stage company might be viewed a little bit like bridging finance. It's a bit of stopgap funding to get you from one point to the next. And it can look really good, I guess, on your pitch deck. It can indicate to investors that you've already been through a competitive grant process and your company's been picked out of the pack, and in that sense there's been some triaging done, and you're a company that's really worth looking at. And clearly the capital you've got then in those circumstances is non-diluting capital. The downside, one of the downsides, is that these grants are generally made on strict terms as to how the money's spent, and will include a range of obligations on you in relation to reporting and accounting. Payment will usually be tied to the achievement of milestones, so you won't just be given a single bucket of money. You'll have to achieve each of these milestones to get the relevant payment. There's also the risk that the funding for the grant may not be paid in full if the program's defunded for any reason, and the grant contracts will provide for that flexibility. Could happen mid-contract that you lose the balance of the funding. So you'll need to factor that into any contracts that you then have with collaborators or customers. Just further in terms of some pros and cons, we've talked about not having to issue equity. You also don't need to license your technology to the provider of the grant, so you're left sort of clean in that regard as well. In terms of some other challenges, obviously grants are a competitive process, and as a startup, I guess you're often accustomed to competition, but there can be huge numbers of people that apply for grants. There are 127 applications and only 10 grants in the last CRC projects round. And there can also be really a lot of work that goes into preparing these applications. Some companies can work for sort of 6 to 12 months in pulling these together, particularly if you need input from a number of other collaborators in the project. Funding can often be terminated too for sort of hair trigger breaches of the funding agreement. You need to take care with conflicts, etc. You'll need to be quite squeaky clean in terms of governance and compliance. Also, grant agreements often have some restrictions on actually purchasing hard assets with the cash that you receive. So if that's something you need funded, a grant may not be the right pathway. And then finally, you often need to establish that you've got matched funding for the grant that you receive. So you need to be able to partner with other parties who'll provide either cash or in-kind contributions, and the grant guidelines will generally specify who those partners need to be. So they might need to be a university or a research institute or an SME or some other Australian company. So you need to make sure before you invest all the time and energy in applying that you can meet all of those requirements.
Great, thanks, Fran. So in terms of alternative capital, we've talked about licensing deals. We've talked about, as Fran's just talked about, government grants. Anton, crowdsource funding. Tell me about that. And we've got some legislation, I think, a couple of years ago that legislated that. How does that work? And again, some of the pros and cons with crowdsource funding. Think you're on mute, Anton, maybe.
Thank you. Sorry. Yes, crowdsource funding is quite new. I think the legislation came into force at the back end of 2017. What it allows is funders or small public and proprietary companies to source funding from the public in exchange for equity via a crowdsource funding platform. Crowdsource funding is different to crowdfunding, which everyone's all heard about, I'm sure, where businesses can raise money from platforms such as Kickstarter and Indiegogo and others, where the businesses offer services or gifts in exchange for the money raised. They're not via those crowdfunding platforms offering equity, and so they don't, they're not subject to the same regulatory overlay as this new crowdsource funding method. So it's regulated under the Corporations Act. ASIC's produced a few guides. There's a lot of material online, so you can read up about crowdsource funding at your leisure. But what the regime's intended to do is really give another avenue for small public companies, small proprietary companies to be able to reach retail investors that they wouldn't otherwise be able to reach. I think it's worthwhile because given it's quite new, it's worth diving into a little bit of the detail about how it works, who's eligible, and some of that detail. I'm going to speak quite quickly to save time. I think it's worthwhile doing it, so please bear with me. So under the regime, unlisted public and proprietary companies that have, together with their related parties, less than $25 million in consolidated assets and annual consolidated revenue, and their principal place of business and the majority of their directors are in Australia, these eligible companies, they can offer ordinary shares to retail investors, which they otherwise wouldn't be able to do, through a crowdsource funding intermediaries platform. Those eligible companies, they can raise up to $5 million in any 12-month period, so that sort of ticks over every 12 months. On the other side, retail investors who are participating, they're limited to investing no more than $10,000 in any company, and they benefit from a 5-day cooling off period from the date of the acceptance of the offer. So why do it? What's the merit of this? Well, as I said at the outset, if you're a proprietary company or if you're a public company with limited resources, you'd find it, well, you can't if you're a proprietary company. You'd find it difficult if you're a public company to access retail investors. It's a pool of capital that's not for you. So this regime gives you that access. So that's the merit. And helpfully with this regime, thoughtfully with this regime, the shareholders holding only these crowdsource funding offered shares, they don't count towards the what is otherwise the 50 non-employee member limit for proprietary companies. That's important, and also certain, but not all of the takeovers rules are disapplied, where you've got these CSF offered or CSF shareholders. Now this very obvious merit to crowdsource funding really needs to be balanced or considered alongside what which is perhaps not surprising, but an additional regulatory overlay that wouldn't otherwise apply, particularly in the case of small proprietary companies. What it means is if you have a successful CSF fundraising, you're going to have to start to report, prepare financial statements as you would if you're a large proprietary company, and that means annual financial statements. And if you raise over $3 million through the fundraising, you'll need to have those financial statements audited. So there's that additional requirement. You're also going to have to comply with the provisions of the Corporations Act concerning related party transactions, and that normally only applies to public companies. But if you're a small proprietary company using this avenue to raise capital, that will now apply to you, and that means you need to get shareholder approval for where certain benefits are provided to directors, related parties, their spouses, etc. So in thinking about utilising this new crowdsource funding route, I think what you've got to also keep in mind is that you may end up with a large number of shareholders on the register. And while that's not a problem for meeting some of the tests, some of the triggers under the Corporations Act, as I mentioned earlier, that might be off-putting to later round investors. Later round investors, particularly venture capital investors, they prefer tight share registers and they generally look to have the number of shareholders on a register of a startup reduced before they invest. So take that into account, if you're considering this new crowdsource funding route. Yep.
Thanks, Anton. Just to sort of finish off, maybe I can cover this. On the debt side, there are a couple of other alternative funding options. We talked about bank loans previously. There are a number of peer-to-peer lenders out there targeting both consumers but also small businesses and startups. And similarly, Con, I think we're finding that some of the venture capital firms are actually looking at debt as well, which is interesting. I think the thing about any form of debt, if you're a startup looking at debt, is usually unless the company can stand up on its own 2 feet in terms of making a profit, generating revenue, in almost all cases, if you're sourcing debt, you'll need to have personal guarantees and provide personal security. So I think that's probably on all the debt sort of classes, that's the main thing to think about. Whether you're prepared to give the personal guarantees, or is your startup mature enough that you're actually generating revenue and you won't need to do that. Just before I wrap up, Fran, I might throw to you just for one last question in the Q&A box, which is around corporate grants. And I suppose this applies not just to grants, but all sorts of potential investors, whether they're really potentially corporates who are offering grants might just be fishing for new ideas, and what their motives might be. Any thoughts on that? Yeah,
I think in most cases they probably are. But that's definitely a motivation, I guess, is getting that early sight line on what's coming and an opportunity to engage with you. So I think it's an issue that should be addressed head on, and you normally have confidentiality terms in these arrangements, and as the startup and the provider of the technology, you might seek to say that the grant provider can't be making use of anything you disclose to them unless you agree, or unless a license agreement is entered into. So for sure, I think they'll be looking for that. As to whether they can make use of it without a license from you is another question, and it's an issue that I think you should address head on.
Thanks, Fran. Maybe just to wrap up, I'll just give some sort of final observations and then throw to the other panelists, because I'm conscious we've got about 3 minutes and we're keen to finish on time. I think from my perspective, you know, the purpose of this discussion is really to make sure that as a startup company, you know what pools of capital are out there and what's available to you and what might be appropriate for you at your particular stage. So, you know, if you're a very new startup, the pools of capital might be quite different to a later stage startup. So really, you know, just understanding what's out there, what the viable options are, and I suppose where you can get most bang for your buck is also important. And really, you know, that's really what we've been trying to do with today's presentation, is just let you know about some of those pools of capital. Kon or Anton or Fran, any other sort of concluding final comments from you guys?
Thanks, Jonathan. It's Kon here. I'd say one other thing, you know, and we're sort of watching this space with interest, is we are seeing, you know, some venture debt in the Australian market, you know, some One Ventures and NAB provided. But this is not, you know, lending of last resort. This is for startups that would rather not give up equity and have the luxury of very established revenue streams that can actually borrow on a secured basis. And in the US, certainly there's a new sort of form of funding, you know, similar to venture debt, but it's really, you pay back a percentage of your revenue every year, revenue-based funding or revenue-based investing, where we get to really see that in Australia. But there's some trends that are there that, you know, we might see in the future.
Just from me, I guess a couple of key points. Recognise IP as an asset of your company, protect it carefully, give proper thought to when is the right stage to be entering into licensing agreements, and don't do short-sighted deals.
And for me, I'd echo that, Fran. I think pick your eyes up from your feet and plan a few years ahead, think a few years ahead when you're looking for funding, and make sure you've got sort of that trajectory in mind when you're selecting funding at an early stage, that you don't hamstring yourself with a bad deal or a crowded share register or poor terms early doors, and make it difficult for you to achieve success in the future.
Excellent. Thanks everyone. I think we're about to hit 2 o'clock, so I will finish up there. I know there's a recording, so hopefully if you need to get a copy, that should be available. And our details are on probably at least some of us on the CORRS website if you do need to contact us. But thanks for attending. Really appreciate it, and hopefully we'll catch up with some of you in the not too distant future. Thanks everyone.